Hey you guys, welcome. I'm Jeff Donut. This is the Animal Donut Show, and today we're going to talk about the Invesco Russell 1000 Multifactor Dynamic ETF. Let me just tell you something. If a company uses that many words to describe their ETF, it's probably not that great. They're probably trying too hard. I want to tell you something. This is a really cool story. This is a story I told to a friend like 20 years ago. And one of the last times I talked to him, he said, "This is something you told me, Jeff. I've never forgotten it." And it's this: mutual fund and ETF companies, they're marketing companies. At heart, they are marketing companies. What they do is they make a whole bunch of different funds, ETFs or mutual funds, and then they run them for a while and see which ones get the best returns. And then what they do is they promote those. They market their best portfolios, the most successful, and then they kill off the losers. The bad performing funds just kind of get folded in. They kind of disappear. They're like eggs, egg whites. They just get folded and they kind of get pushed aside, and nobody sees the losers. And then these companies run ads in Morningstar, they run ads online, they run ads in all the financial publications, the Wall Street Journal, Forbes magazine, and they say, "Look at our great star ratings, our 5-star funds." So this particular ETF, I think, got a lot of hype because some people asked me about it, at least one person last year, and I went ahead and made a video. I'm glad you asked me about it. But I've now followed this ETF, and now having had a little more than a year, maybe 2 years of experience watching it, I'm not so convinced that it's a dynamic ETF. And so the name, Invesco Russell 1000. So they're investing in stocks in the Russell 1000 index, and then they have dynamic multi-factor ETF. What does this mean? Let's break it down. Okay. According to their website, I actually went there. I clicked over there just for you guys today. The securities are assigned a multi-factor score from one of 5 investment styles. Okay, so they're giving it a 1, a 2, a 3, or a 4, or a 5 based on 1, value, 2, momentum, 3, quality, 4, low volatility, and 5, size. And I will use this right here as a little visual because we all like a nice visual prop. Something to give the visual cortex in our brains like a little something to look at. So one of them was size, momentum, quality. Who decides what's quality, right? Low volatility. So you want a stock that's low volatility? Well, I guess that rules out just about everything in the stock market now. And size. Well, I don't know. So I think what they're doing is they're trying to gather assets into this ETF and trying to get really good returns so that they can then say, hey, put your money in this, not in VOO, okay? Because everybody knows about the S&P 500, but not everyone knows about dynamic and multi-factor. Well, I'm here to burst the bubble of the Invesco company or whoever makes this particular ETF. And I should say here, this is not investing advice, okay? I'm doing this to have a little fun and also to help teach you guys who might not know a lot about ETFs or about this whole marketing thing about how this is all working. Now, let's just start with a number, okay? 0.22. So 1/5 of 1%. That is the total return of this ETF. The ticker symbol is OMFL. So it's returned not 1%, not even 1/5 of a percent so far in 2024 as of Friday, August 16, 2024. The S&P 500 ETF VOO has returned 17.48%. This particular ETF, this Dynamic Multifactor ETF, which is not very dynamic, in my opinion, has not performed 17.48%. It hasn't even delivered 0.48. So what's going on here? I'll tell you what I've seen. This particular ETF had some of the big 7 stocks about a year ago. They had a lot of the big names. You know, the big names we all know about. I don't need to repeat them here. And I think they decided at the beginning of this year to switch, because I noticed that all of a sudden the stocks in these top 10 were those companies we've never seen before. Like, you know, the ones you look at some of these ETFs and they've got 10 stocks listed and you've never heard of any of them. That was the portfolio. And I went, whoa, this is impressive. Maybe they know what's going on in the recession. These fund managers, they know the stocks to go into. Well, I think what happened is they messed up. I think they screwed up, because the return of this ETF is 0.2%. And the stock market is up 17.48. So then I look today at the top. Let's just look at the top 7 holdings, okay? Berkshire Hathaway, Costco, Meta, Microsoft, Nvidia, Amazon, Apple. Sound familiar? Well, it should, because those same stocks are in the top holdings of VOO. Berkshire, Meta, Microsoft, Nvidia, Amazon, Apple. The only difference is the Invesco Russell 1000 Dynamic Multifactor ETF has Costco in its top 7. And VOO has a slightly different composition. I think they have Google in their top 7. Big deal. My point is that the expense ratio for OMFL is more than the return of this ETF so far this year. You'd pay 0.29 expense ratio for this ETF, and it's only returned 0.22%. So any ETF that charges you more than you get in performance is charging you way too much. I'll just check them out right now, because I got my phone, I got my app, I can show you what's going on. Okay, top 10 holdings, Berkshire Hathaway, okay? So far this year, 24.76, practically 25%. Way to go, Berkshire Hathaway. Costco so far this year, 32.78. So how does this ETF only have a return of less than 1%? If its holdings are Berkshire, Costco, let's see what Meta's delivered. Meta, 49.77. So Meta's delivered 50%. So what you can see here is this ETF was not in these stocks when it created this return of less than 1%. Its other holding here, Microsoft is up 11.77. The next holding is Nvidia. Nvidia is up 152% so far this year. Amazon so far this year is 16.65. And the 7th holding in this ETF is Apple, and Apple is up 20.73. So how is the total return of this ETF less than 1%? It doesn't make sense. So what I think happened is they were all out of the big names that generated the big return so far in 2024. And somewhere, I haven't been looking that carefully, but probably sometime in the last few weeks or months, they just switched over and said, we better get into these big stocks. But they must have gotten in a little late, because they didn't get any of the upside from these companies, whether it's Nvidia or Amazon or Apple or Berkshire or Costco. And so you're left with really lousy returns if you own shares of this ETF. And it's yet another reason why sticking with the plain Jane, the vanilla, the boring S&P 500 or the total stock market is often just the best way to go, because you don't need a lot of excitement to generate really solid returns. Wanted to just make this video for you. If you haven't yet, tap the little like button. Please do it. It's super helpful to the channel, helps push the video out so that more people see it. And also, if you're not yet a subscriber, I talk about small cap stocks, I talk about ETFs, I talk about semiconductor stocks. These are a few of my specialties. So if you like seeing that in the videos that you watch when you're clicking around on YouTube, then hit subscribe. You won't have to do so much clicking and scrolling. You'll just get a notification. It'll say, hey, Jeff made a new video. You might want to check this out. And why you might want to watch this is, I've talked about not only a couple of ETFs to stay away from, like OMFL, but I've talked about a few stocks, companies like Aspen Aerogels, companies like Excelis Technologies, Camtech, Nova Limited, companies that are doing really well. Transmedics is another one that I just invested in recently. And I'm just very impressed with companies with really good managers, CEOs, teams running the show. And in the next few months, I plan on talking about a few other stocks that I've never even mentioned. These words have never flown out of my mouth before because I've been learning about these companies lately, and I haven't yet made a video about them. But these are companies that I think are going to be shaping things from now on. And I think that kind of skating where the puck is going instead of where it's already been is kind of the way to go if you're an investor or a trader. And so these are the kinds of things I share with people who watch this channel. I think it's kind of amazing actually that I have such a kind of small group of devoted viewers. I know you guys by name. I know you guys by little avatars. What is it? Your username. People like K to the LL who have been here since the very beginning. People like Logan, Keith, and all of you. I just love seeing your little comments underneath the videos because, it takes some time to think about what to talk about, write a little script here, get the numbers down, remember the company names, and remember what I want to say. So when I do that, it's pretty cool that you guys share info. But what I like is this kind of small group of viewers is kind of getting, I think, some pretty cool firsthand knowledge of some of these small companies. And I've watched a lot of other financial channels, and it's just like Nvidia, Meta, Google, Apple. I mean, it's just like all of the same stuff again and again, but I haven't found many channels. Oh, and then there are the ones that just bore you with all the spreadsheets and the discounted cash flows and all the numbers. People get like really into the numbers and the math, but I don't hear that many channels where people talk about a stock as kind of a part of a company and like which companies are really on the way to doing something great, something a little bit different and with really good management. If you're taking your own hard-earned money, you're going to put it in the stock market. Who wants to lose money, right? I mean, come on. There's nothing worse than putting money into a stock. That's not good. I believe that the more we can learn about companies, the more that we can learn about what makes them run, the more we can really understand about the company and what we're investing in, the greater our chances that the companies will be able to increase their earnings over time. Because most of the time, again, not investing advice, but my observation is that the companies that are able to increase their earnings over time and build a durable competitive advantage, like a moat around their businesses, those companies usually see the stock price follow the growth in earnings over time. I think Costco is a great example of that. I think that Berkshire Hathaway is a phenomenal example of that. I think that Amazon is another great example. Again, not recommendations, not advice, but these companies, as they've grown, their stock prices have grown right alongside. Thank you so much for watching. Tap the little like button if you haven't. Subscribe if you want to get notifications in the future. I'm so glad you joined me. I will see you in the next video.